Hi everyone, Shaun Humphries here with Assante Capital Management. Welcome to our series on successful investing. So in this particular video, we're going to talk about the investment policy statement. Sometimes we refer to that as an IPS. Now the IPS doesn't sound like a very exciting topic, but it is a foundational document to help you to be successful with your investment planning and your portfolio. So we're going to unpack the investment policy statement in quite a bit of detail, but let me just give you a short introduction. In the very first video of our investment series, we talked about the ingredients that lead to successful investing and some of the things that keep us from being successful with our portfolios. And one of the biggest issues is sort of what's between our ears here. Not so much our gray matter or our smarts, it really is our emotions. And our emotions can hijack our ability to be successful with our portfolios. The investment policy statement is a document that links your financial planning with your investment portfolio. It helps to remind us of best principles, best practices when it comes to investing. And it really sets the tone for the structure of your portfolio. And it comes out of a detailed discussion around your appetite for risk, so your risk temperament, what your return objectives are, what the goals are for the portfolio. Many things go into the investment policy statement. It's like a mini plan for your portfolio. So we're going to talk about the construction of the investment policy statement. I'm going to actually show you an example of an investment policy that you can take a look at as well. And I think you'll find it a very helpful discussion. If your advisor has not put together an investment policy statement for you, I would recommend that you sit down with your advisor and have a discussion on the importance of this document. And it's a great document because it holds both you and your advisor accountable, or you and yourself accountable, to the decisions you made in advance of investing. I'll give you a really good example. So let's say we look at the area of risk temperament, which is actually discussed in the investment policy statement. And so if I'm a balanced portfolio investor, kind of a moderate risk investor, that's going to have a certain kind of flex to it in terms of the highs and lows on that portfolio. And if we've discussed it with our advisor, we've gone through all the pros and cons, and we land on that particular strategy, then after the fact, there's this accountability loop. In other words, if we see a certain degree of fluctuation on the portfolio, and it's consistent with the upfront discussion we've had with our advisor, we shouldn't be coming back to our advisor and saying, why did you put me in this portfolio? This is completely unacceptable. When in fact we've worked with the advisor to craft a strategy that is consistent with your goals and your risk temperament. So that's one example of how that document gets used to hold the advisor accountable to the client and the client accountable to the advisor in terms of the appropriate behavior to achieve the goals that you're trying to accomplish. So the investment policy statement is not something that's always done in our industry. It should be done. And like I said, if you haven't had one prepared by your advisor, I would encourage you to sit down with them. So here's a bit of a definition for the investment policy statement. Investing is always purpose-driven. And again, when we say purpose-driven, it's linked to your financial goals and objectives, whether it's buying your dream cottage, seeing your children graduate as an example, or ensuring that your golden years are nothing but golden, so long-term income security where you're not worrying about inflation or longevity risk. A tailored plan is essential to ensure that your unique goals come to fruition. So what we're talking about here is trying to increase the probability that you'll achieve your long-term financial goals, and an investment policy statement really is intended to ramp up those laws of probability for you. This is a good chart because what it's designed to do is to highlight the fact that on the left-hand side, you've got the example of retirement income planning. And a big part of what we do as a practice is to help our clients get ready for retirement, transition into retirement, and then be retired. And it's an ongoing conversation that we have with clients. So ongoing discovery and questions, discussion around planning opportunities, decisions get made, the delivery of the planning, and the help the client to execute on the plan. Now on the right-hand side of this chart, you'll see the investment strategy. An investment strategy should come out of or flow out of the planning you do in your overall financial plan or maybe your retirement income plan. And that's around then the design of the investment policy statement, the implementation of that statement, of course the monitoring of the portfolio, and the rebalancing as necessary. And you continue to review the investment policy statement because both personal circumstances and financial situations change, and that policy statement needs to be updated to reflect those changes. So your policy statement really outlines your course by clearly defining your goals, how much risk that you're prepared to take. It addresses tax concerns through the investment strategies and tax-efficient investments. So how do we try to reduce the total tax bite in the portfolio? That's talked about in the policy statement. And then consolidating your family's registered and non-registered investments under one single plan. So sometimes clients will want us to look at portfolio returns as a singular mandate for an account, but generally speaking, our default is to look at your portfolio holistically and look at the overall performance, because generally speaking, our financial plans are designed to look holistically and come up with what kind of return on an after-fee basis we need to achieve to help you accomplish your goals. The policy statement identifies your asset allocation between stocks and bonds and real estate and the percentages between each of those areas, presenting you with investment strategies using whether it's managed accounts through managers that we've headhunted and selected who are best of class. It could be ETF structures, individual securities in the portfolio, and then identifying the range of returns that you should expect from your portfolio over time. And so as you extend the time frame in your portfolio, the probability is you'll come closer and closer to the expected returns on the investment mix. And that's talked about in the investment policy. Okay, let's take a look at a sample investment policy. So I'm going to walk you through the investment policy statement itself, and hopefully you'll find this to be sort of a useful discussion as we go through it together. Okay, so what you see in front of you is a sample investment policy that we've put together. And this policy statement, again, most policy statements will be linking directly to your financial planning or financial forecasting. And you can see that in this policy statement, we do have the beginning of a discussion that looks at the client's characteristics around. So here's Sam's sample. And so we're looking at age, investment time horizon, which in this situation was 11 to 15 years, their investment knowledge. Understanding investment knowledge of the client is critical because if a client's unsophisticated, we need to spend a little more extra time updating them on how investments work. We don't ask our clients to become experts, but we do ask our clients to invest a bit of time in being conversant with basic concepts, because the more informed a client, the better the chance that they'll make good, disciplined decisions over time in their portfolio. You can see here they're currently saving 4 to 9% of the income. That influences the portfolio design. Their objectives in this policy statement was moderate or modest growth. They were willing to accept medium risk in terms of achieving their goals. They told us that they could stomach, they wouldn't be happy with this, but they could deal with a 10% cumulative decline on the portfolio over time. And if their portfolio declined 25%, it would not, they could maintain their lifestyle. They wouldn't have to make major changes. Now, obviously, that's not what we're going into this whole exercise to achieve. We don't want to be losing money, but the reality is, out of a 10-year market cycle, we're probably going to have at least 2 years that'll be negative or subpar, and we have to have frank conversations with clients about what would their behaviors be if that happened. Could they stomach that? And if they can't, then that's going to influence our portfolio design. If they can, then that gives us a little more flexibility in terms of the design of the portfolio. Okay, so that's the first part, is a whole bunch of questions around the design of the account. Now, the other thing about portfolio design is something we refer to as the efficient frontier. We may have alluded to this a little bit in previous videos, but basically when we begin designing a portfolio, the client is going to articulate their financial goals and objectives, and then we're going to come up with a portfolio that is going to give us the return that we require. So let's say we did a financial plan, and it's confirmed that the client needs 5% returns over time to achieve their goals. Then we want to design a portfolio that, for the lowest level of risk, has the highest probability of achieving those returns. So how do you do that? Is there a science to it? And actually, there's been a lot of research done over the last several decades around portfolio design and what's called efficient portfolios. And if you look at this chart here, there's this line that cuts across, and that line really is designed to represent almost an infinite number of portfolios along a continuum between the least amount of risk and the most amount of risk, and from less return to better return. And so we've been able to model portfolios, and money managers and portfolio analysts have come up with portfolios that will be a mix of government bonds, corporate bonds, real estate, stocks, geographically diversified between Canada, the US, globally, diversified among big cap stocks, small cap stocks, mid cap stocks. And so all these investments are looked at in the context of one another, and they're looked at in the context of this thing called negative correlation, which we've talked about before. So investment A may do that, and investment B might be doing this. Over time, what you're looking for is a stability, consistency of return. As one asset class is underperforming, another asset class is doing better to prop up performance. We don't have a crystal ball, no one does. And so by selecting assets that are somewhat negatively correlated, that leads to less total fluctuation on the portfolio. We know historically that generally bonds and real estate would be negatively correlated to the stock market. And so we want to make sure we mix those investments to find a mix that is in line with the client's risk temperament. And so once we do that, we can find portfolio. And this is a great example where I have people coming into my office and we look at their portfolio and I go, well, your portfolio A, which you currently have, has a risk profile right here with a return profile here. Let's say that's 3%. And the first thing I would say to them is, there's portfolio B here that for way less risk generates the same kind of return. In other words, your portfolio A is less efficient. On the flip side, we know portfolio C is over here, which has the potential return of 7%, and its risk profile is the same as portfolio A, which you currently have. If you wanted to take on the same level of risk, we have the potential to enhance the return. So it's a way of framing the discussion about how we can build portfolios to look at these trade-offs between risk and return. We always start with the plan, though, is if the client needed to get 3% to achieve their goals, our tendency would be don't take on unnecessary risk. If you can get your goals achieved by taking on a portfolio that gives you 3% for less risk, then maybe you want to do that. So every client's different, but it's an important discussion. So that's the efficient frontier that's talked about in the design of the account. This particular client had a portfolio that overall 40% of the portfolio to drive the returns that they needed were in capital preservation assets, and 60% of the portfolio would be in growth assets. So basically in the stock market for all intents and purposes. So when it came to the portfolio, again, the investment policy will speak to the range of returns potentially in the portfolio. So we know that when we build a portfolio, other than money that might be sitting in cash equivalents, high yield savings accounts, term deposits, or GICs, so investments that are not market driven, everything else is subject to what's called a secondary market, and they're going to get valued every second of the day. The longer the time frame, the more you squeeze together the degree of fluctuation between the expected return and the actual return. The shorter the time frame, the greater the fluctuation you see potentially in the portfolio as an example. And so that's an important piece that the investment policy speaks to. We then get into customized portfolios, and you can see this client has a portfolio that has 23% in Canadian stocks, 14% in US stocks, 16% in international stocks, 7% in real estate, 34% in bonds. Between real estate and bonds, 40% capital preservation. And then once we have that generalized mix in place, we'll begin using actively managed what are called pooled accounts or institutional money managers or ETF structures, sometimes individual stocks or bonds, to begin building this mix for the portfolio and for the client. We'll get into discussions on tax optimization. Obviously, there are ways for us to try to reduce tax. It could be discussions around the deferral of tax, creating dividend income, capital gains income, minimizing interest income, and then depending on where investments are held, between tax-free savings accounts, RSP or registered accounts, and open accounts, that will influence the structure of the portfolio. We also are big believers, if you've gone through the previous videos, around active rebalancing. And so rebalancing happens at different levels. It can happen at the level of this portfolio where we want to systematically rebalance on a regular basis. We don't want to get too passive on that, because if you don't rebalance over time, your growth assets will outperform your bond assets, and increasingly your portfolio will get more and more aggressive and fall outside of your risk temperament. You want to make sure you're harvesting profits, rebalancing the portfolio, fine-tuning along the way. Under performance expectations, you can see that the portfolio expectations on this account were between 2.47% and 4.46%. And we always look at returns. We call it the MAP, the Managed Account Premium. And that Managed Account Premium is above what we refer to as the risk-free return. So what would be an example of the risk-free return for portfolios? Well, a good way of looking at that would be things like T-bills or GICs. So let's say that my GICs or T-bills are paying 2.5%. That's the risk-free return. And then if you look at this investment policy, it's basically saying, well, we're going to get 2.5 to, let's say, 4.5 above that risk-free return. So our return is going to be anywhere from, let's say, 5% to 7.5%. Okay, so if we look at the portfolio design, that would be the expected return that the client would have. Now again, when we look at returns, you already know this from previous videos. It's not a straight line kind of thing. We don't build portfolios. In an environment, let's say the guarantees are paying 2% or 3%. For me to say to a client the expected return over time is going to be 5 or 6% per year. And there may be a very high probability that we will hit that return over the next 8 to 10 years. But in that time period, there could be fluctuation of return. Some years we could get 2%. Some years we could get 12% or 13%. Some years might be minus 4%. So on average, we might be hitting that 5% return or 6% return, but there'll be year by year volatility. Now, there's ways of protecting us against short-term risk. The average returns might come into exactly where we want them to be, but if we need capital, obviously in the short term, and markets are down 6%, which in a balanced portfolio is very conceivable, we need to have money on the side to look after liquidity needs. That's part of what an investment policy statement contemplates. Other than this return and the goal that we're trying to achieve, what do we need as income? What do we need for liquidity over the next 1 to 2 to 3 years for expenses? And so what you end up doing is compartmentalizing the portfolio, where you go, okay, I've got the overall mix, and then I might have a percentage of the mix that's very conservatively invested that's going to be used to pay income and liquidity needs out of the portfolio over the next 1, 2, 3 years as an example. Now, the reason you want to make sure you segment your portfolio like that, particularly as you get close to retirement, is you don't want to have to sell off financial assets at a loss at the time that you need those financial assets. That's why you have the investment policy speaking concretely to the needs that you have from the portfolio. You want to make sure that you have not only talked about the growth you need to achieve your long-term retirement objectives, but you want to take into account, are there any expenses this portfolio has to look after over the next 1, 2, 3 years? Is there any income that this portfolio needs to look after? That needs to be contemplated in the context of this investment policy statement. Okay, so those are the main points. This policy statement's been uploaded to the hosting page for this video, so you can take a look at that. And again, if you don't have a policy statement in place, I would encourage you to sit down with your advisor and make sure you have one in place, because it's a great document. It begins linking very precisely your investment plan to your financial plan or your retirement plan. You want to make sure it's your plan that defines return goals, not the other way around. Okay, let's just make a few concluding comments. I'm just going to close up this discussion on investment policy statements. So just a few concluding comments about the IPS, or the investment policy statement. So number one, like I said previously, sit down with your advisor, or maybe you do it on your own, to clarify, to do the forecast, to look into the future about what your goals are, and then work backwards to define what kind of returns you need to get. Once that's defined, then go through a risk assessment, match that with your return objectives, and get very precise about what this portfolio needs to do for you. That should be baked into the investment policy statement. There's a sample you can take a look at that sample, and that sample can be a basic outline of how to produce your own investment policy statement. If you're not inclined to do that on your own, then be sure to sit down with your advisor and they can construct that for you. It's my hope that you found this discussion helpful. If you want to reach out to our office to have a more detailed discussion on these topics. If you are taking a look at this and you're going, I need to take my portfolio design to another level, I wouldn't mind having a conversation with Shaun and his team about how to craft an IPS. Then, of course, Humphries@Assante.com is a website. Phone number is 204-977-8049. Of course, you've got the website, ShaunHumphries.com. Anyway, wishing you all the best in your both wealth planning and your overall investment planning. You take care. Bye-bye.